How's all that cash in your pocket?
Something's burning. I don't think it's a hole in my pocket. I think it's just the cash itself.
How much cash do you have? I'm gonna check my wallet.
Oh, in my wallet, I
Yeah.
usually try to keep $20 to $40 cash.
Okay, I have 36.
Yeah, so there you go. You're in the zone. Is that typical, or do you carry more sometimes?
I usually don't carry any cash at all.
Yeah, I carry it mostly for cash tips. I think for like in winery tasting rooms
Sure.
and bars and stuff like that. Yeah.
Yeah, that makes sense. I could see that being helpful. But cash is it's a
Yeah.
big topic right now because of inflation, right?
Absolutely. Yeah, I think about it all the time. It doesn't feel very great to have appreciable cash as part of your portfolio right now.
Yeah, so you're post-fi a couple of years here, and you use the bucket system, right?
Effectively, I guess. Yeah.
Yep. So you have stocks in one bucket, you have your fixed income, your bonds, let's say, in another, and then you have cash. Are you treating cash as a separate bucket there?
I mean, I think it's all just kind of labels at this point. What I usually say is my portfolio is 70-30, where 70% is equities and 30% is fixed income. And that's really divided between about 25% treasuries and bond funds and 5% in cash, which is effectively a couple of years worth of expenses at this stage. And that's what I try to maintain, generally speaking.
How'd you come up with a couple of years?
Some kind of finger to the wind estimate, seeing what other people did. I know Fritz Gilbert, Retirement Manifesto, has always advocated for 3 years or more. Some traditional retirees obviously keep a lot more than that. And none of that felt, going far out there, never felt very good. Inflation risk is a very real thing. And of course, we'd rather have money in the portfolio doing something, even if it's part of a bond allocation where it may not be expected to make big returns, but it's not sitting in a money market checking account losing money. So I guess at this stage of the game, it's an element of managing sequence risk, at which point Karsten will tell me I'm market timing because I am, and I want to talk about that. But it's effectively the pot of money that we use to pay ourselves monthly, just like we were getting a paycheck. And I try to keep it within a certain range.
I thought you were going to say that you matched it to the average bear market.
Yeah, I mean, that was part of the thought process way back when. I think you and I have talked about this before. This whole somewhere between 2 and 3 years feels pretty good for that reason. That's part of the justification. But yeah, I don't always answer as cleverly as I should.
No, I wondered because, the more I've researched bear markets lately, the more I realize, okay, well, maybe 2 years is it's not all that conservative, actually. It's kind of an aggressive allocation because, it's one thing to technically come out of a bear market, but it's another for your portfolio to recover to a state where you actually want to start making some draws on the stock portion, right? Start cascading and refilling the buckets.
That's right. But on the same note, a number of the people who we follow and value their feedback, people like Karsten and Jeske, they don't advocate keeping a big bucket. They say, the sequence risk calculations include, and I'm paraphrasing here, these are my words, withdrawing from your assets periodically as you go. And having a system for that is kind of the best practice that's recommended.
Yeah. One of the reasons Laura and I have been using his safe withdrawal rate toolbox. And one of the great things about this is that it gives you the fail safe rate of withdrawal. So, we're looking at that number saying, as long as we can maintain the withdrawal rate, like under this percentage, it's even going to weather the worst case scenarios, the Great Depression scenarios, stagflation scenarios. So there is some comfort in that.
Oh, I agree. And it's funny how easy it is to put this stuff out of your mind because, you and I talked about the safe withdrawal rate toolbox, a year, 2 years or more ago before we were even having these conversations for the show. And it's easy how quickly you forget the details of that. So just, you and I having the chance to talk with him made me go back to my toolbox and go through it again and maybe make some little adjustments. And, I find myself sitting there actually feeling relieved.
Yeah.
That I'm being a little too conservative, and a little conservatism and cushion is not a bad thing. But when I look at those worst cohorts and those fail safes, even with high valuations, the CAPE ratio being really high, I actually feel a lot better about holding less cash.
Yeah. So recently you and I met with this certified financial planner, and one of his recommendations, the next action item set for me was to build up my emergency fund. When I think of holding cash, I think of emergency funds. When I think of talking to financial advisors, some of their first advice is always make sure you have an emergency fund, and I've heard anywhere from 3 to 6 to, 8, 12 months of cash in this emergency fund.
Yeah.
Let's talk about that.
Yeah, I mean, so I've always been an advocate of emergency funds with some kind of guidelines around it. Maybe you can't save 3 to 6 months early in your career, but having that proverbial $1,000 to weather some unexpected expenses, and then as your career progresses a little, maybe 3 months, and then particularly if you're in a job where a traditional job, and we'll come back to business, personal businesses like yours. But if you have a job that you couldn't immediately replace, in a couple of months, and maybe 6 months would feel better then in terms of the type of emergency fund to have. And I'll be honest, that's exactly what I did. As my career progressed and I started to think about, well, what if I did lose my job unexpectedly? It felt like a good thing to have 6 months of cash around. But on the same note, I always felt like I was still being too conservative because I had plenty of credit available to me. And low interest rates. And I certainly could access money, but I guess it came down to security. I mean, how did you feel about it? Because you went from a traditional career to starting something up yourself and then becoming successful. Did your feelings change over time?
I mean, I'm going to be honest here. I never had like a 6-month emergency fund. And maybe this speaks to some people who are earlier on in their path.
Yeah.
My wife and I started our careers not earning much, like everybody does pretty much. And the thought of trying to save up 6 months of expenses on top of what I thought was a more important goal, which was to start investing at an early age. Because those are kind of two competing things right here, right?
Yeah.
They're always saying like, save that first dollar and get that to work for you, because the earlier you start it, the more leverage you have there. I was way more excited about the thought of being able to invest some of that money than I was about building up some emergency fund for, when you're young, you haven't seen a lot of emergencies. You haven't seen the car really, break down on the highway. You haven't had to do the emergency repair.
I think you must have drove better cars than me, because I broke down on the highway a number of times. Thank you very much.
Really? So you tapped into your emergency fund for that?
No.
I mean, I never did.
I said it felt like the right thing to do. It doesn't mean it actually practically had a lot of utility. I think for me, honestly, it was like some kind of security blanket, if I'm being honest.
Yeah, well, but I mean, so early in your career, you built up this emergency fund, and then you started investing. Like you were that disciplined?
No.
Or, I mean,
and certainly I didn't know about any thing that would now be called a financial order of operations. But I did in my head, I think. I did start investing early in a 401k, like we've talked about before. I had a little bit of money in savings for emergencies, but it definitely didn't start as 3 or 6 months. I was doing my investing. I was getting my match once I was eligible for a match. The 6 months came much later, I think, is absolutely accurate.
I mean, by the time I got around to that, feeling like I could afford to save 6 months was more like when I started my business, and there just started to be more cash flows coming in. And then I used that, and we've talked about this before, as a runway.
Right.
And because for me, like you said, security blanket, I didn't want to go back to working for somebody else. I knew this was my path, and I was going to do anything possible to make sure that that was not going to be the failure point for me leaving and going back to work for someone else. So eventually that pot of money just grew to be stupidly large. I mean, it's just, and I think that's maybe what we're talking about here is knowing what the opportunity cost of having those funds out of, say, higher returning asset like stocks or bonds or, some other asset, as opposed to, just holding it in a money market fund or stowed under your mattress or something like that. I mean, how do you view those things?
Well, I mean, they are certainly different, right? But I want to, if it's okay with you, I want to come back to the point you just made. Now, and we've talked about this on the show, you have a variety of passive income streams that I suspect have some level of reproducibility about them. But when you're starting a business and you have a much more lumpy income, it's certainly not terribly predictable. You obviously did elect to hold cash, and it sounds like it grew very large. And it's a different kind of security that you were, I don't know, maybe you weren't actively seeking it. Maybe it was just sort of happening. You were building this up. But I get why that would make sense to someone starting up a totally new venture.
Yeah, I mean, and so do I. I mean, but I guess I let it go on too long. And I didn't have a lot of math behind it, honestly. It's just like,
Yeah.
okay, if it builds up from 10,000 to 50,000 or whatever, I'm just picking random numbers here.
Yeah.
There wasn't a reason for me letting, it slide by 40,000. It's just because what was there,
Right.
There was no plan behind it. And that's why it's funny when I met with this financial advisor and he starts trotting out this plan.
Right.
I wanted to know the reasoning behind it. Well, tell me why I have to have this given my certain set of circumstances. And I think, your point is, well, look at the set of circumstances. And if you do have a lumpy income, like a lot of small business owners do, especially when you're getting started, it makes sense to kind of amortize that, average it out over a year. And in that case, maybe holding, $15,000, $30,000, $40,000 in cash is what you need to do just to survive. So that you're not making bad decisions elsewhere in your investments or in your personal life. But man, it just strikes me that it's so individually biased that it's hard to come up with this like overarching rule that says, oh, you definitely need 3 months of expenses. Cause right now I don't feel like I do.
Well, I think you said a lot there, and maybe this wasn't your intent, but when you talk about, it's individual, I like to think about what circumstances happened in someone's life prior to today.
Sure.
And if somebody came from a home that had big money problems or saw somebody struggle with something really awful that pertained to not having enough money, they're probably going to be more apt to hold extra cash, and maybe to a detriment, right? Because they just are so concerned about that. So it's easy to see this kind of emotional aspect of money play out in kind of cash reserves that people hold. Or on the flip side, somebody in retirement is so risk averse. And I'm not saying that mathematically this is correct. This is emotional. They're so risk averse, they choose to have a very large cash position, even being cognizant of the inflation risk, right? It's going to lose purchasing power over time because they sleep so much better.
Yeah.
It's just anything else feels wrong, even, fixed income, although I don't know why that kind of person wouldn't go with an annuity. But I am aware, because I have talked to people in my life, family and otherwise, who have very large amounts of cash and in retirement.
It's just so funny to me that, the argument for not taking that money and investing it, let's say you're 100% VTI, not investing the whole lump sum in VTI. The argument is there with respect to an emergency fund is, hey, what if the market's down 50% when you need that money? And like, how much is your emergency fund out of that, as a percentage of your portfolio?
Yeah,
you said it's 3% of your portfolio.
5%.
Yeah. Okay.
And I don't necessarily think about it in my emergency fund, but your example is totally valid.
Oh, I'm just saying, like somebody pre-fire. Even.
Yeah,
if you're looking at an emergency fund, okay, well, what percentage of your portfolio is that emergency fund that's actually invested? Because money is fungible, right?
Yep, it is.
And so the argument that always comes back is like, well, if you need that money in an emergency and the market's down 50%, then you're going to have to sell at a loss. It's like, okay, maybe I will, but the percentage of my portfolio that's going to take a hit is so small that I might be willing to take that risk, because the upside of having it in the market long term is that I'm probably good. Chances are really good I'm going to come out way ahead. So that's kind of how I rationalize it.
Well, and this is precisely the point that Karsten made in that series. He had several different posts, as I recall, on not having an emergency fund at all, or my emergency fund is $0.
Right.
And I remember pre-fi reading that, understanding the math, and it's still not feeling right to me. But I'm totally going to come clean now. I'm sort of glad this didn't come up in our conversation with him. I'll come clean because I've been thinking about this a lot lately. Even when I said I have this 2-year allocation of cash bucket that I'm going to be spending for my operational account, I still had a 6-month emergency fund.
Wait, on top of that?
Yes. And so it is very recent.
Man.
And our conversation with him was a big part of it, that I just took that money and moved it out of that allocation into my operational fund. So instead of selling to get 6 months worth of cash right now, I've just moved my e-fund out. It sounds like just an electronic exercise, but it was sitting on a budget line item as my emergency fund.
Dude, okay. Well, let me ask you this: why don't you move?
I'm being honest.
Why don't you just move it all into bucket number 3?
I actually thought about that, and maybe I'll still use some of it, Eric, but it's because I still haven't gotten past the barrier of, you know what, I really want to have, 18 to 24 months of expenses accessible.
But okay, so
in cash.
Okay, so you've spent down 6 months and you're just refilling that back up to the 2 year.
I'm refilling my cash bucket. Exactly.
Okay, it's not like you had 30 months of expenses when we were having this chat a couple of weeks ago.
But no, it's not. But being honest with you, this is actually rather convenient, because going back to that conversation we had, I was absolutely practicing market timing, right?
I
so I didn't make this up. There's a number of people out there following this approach who say, like, one of the strengths of having a big enough cash cushion is you don't have to sell when you don't want to, right? So I don't want to sell bonds because they're, let's say VGIT is down like 9% on the year, for example, which is still, way better than the 20% that VT Sachs is down. But anyway, it's down. And so mentally, I was one of the people saying, well, look, I'm looking here at my investment policy statement. It actually doesn't define, and I'm going to fix this, it doesn't define my selling rules to refill the cash bucket. So I'm just going to wait. I'm just going to sit here on cruise because I got plenty of funds. I have a year and a half. I'm just going to wait and I'll sell later. But, the moment of clarity, that's the very thing that I try to avoid. I have all these things systematized to avoid market timing. And I'm sitting here talking about market timing. And I've had advisors, honestly, talk to me about market timing and it being a kind of an okay strategy. It feels a lot better to automate that. So I'm going to get beyond that, to be honest with you. But for now, the decision is made. I've just moved my eFund out. It's part of my operating account. So now I've taken that money off the table.
Okay. So as of right now, you have 24 months of cash losing out to inflation in an account.
Correct. Yeah. Yeah. I think about that. I'm honestly trying to get comfortable with the idea of putting more of that in equities or at least in bonds.
So what's going to make that decision for you then?
I don't know. I really don't know. I mean, this is going to sound like a cop-out.
Because I'm just going to say you're in violation of your IPS then.
I still have my 5% cash allocation. That's exactly what's described in my IPS.
Yeah, but if you move it out into stocks, you're going to change the allocation.
Then I'll violate it. Yeah. I mean, here's my cop-out answer. I've been assuming that in these highest risk, these highest sequence risk years, that this is the right strategy and that, it's already risky enough, right? We are not doing rising equity glide path. You are not interested in that either. So 70-30 by many people's account is already pretty risky. I'm looking at increasing my stock allocation down the road, right?
But me too. That's what I consider the rising equity glide path. It's like it's like our modified version. Of it. Yeah, I don't want to do I'm not flipping to the bonds so much.
No, I'm not either. And right now it seems even less attractive than ever.
Let's talk about the actual physical location for this cash. Is it in a money market fund?
Yeah, it is. It's right now it's in a money market fund making about the best you can get with a bank, which is around 1%.
Okay. Because if I'm just keeping as I move cash into Vanguard into the VMFF, I think that's the money market fund in there, just to make regular buys. I was checking the expense ratio on that. You and I were having some conversation about asset allocation, and I looked at the expense ratio and there was 0.11%. So 11 basis points. I was surprised by that,
It is, and there's worse than that. You can find ones. So
your Fidelity one was higher, wasn't it?
Yeah, I had depending on the account the type, there were several different money markets that my money used to be in. And again, I wasn't managing it personally at that point in time. And I just realized as inflation started to increase, in fact, it was better for me to have that money in a traditional bank money market where it was actually making more, and obviously there was no fees. So yeah, it's kind of surprising.
So that's something for people to pay attention to, I think, as you're moving and building larger cash positions, if that's something you choose to do. I want to kind of go back to this conversation that we had with Karsten recently about the bucket strategy essentially being window dressing. So should that give you a little more confidence to go more in on stocks with some of your cash position? Because I mean, essentially selling funds, selling stocks to replenish, the other buckets. It's a natural part. It's an assumed part of the drawdown strategy, the decumulation phase.
It is. Yes. And I don't disagree with any of that. That's absolutely my intention. I have a very clear asset allocation, which I keep to. It is defined in my IPS, and I will rebalance twice a year is the frequency that I've kind of landed on. Yeah. And, mid-year and, kind of just before taxes. So you have a chance to kind of, your situation basically. And I will use whatever selling and then coupled with buying to achieve my asset allocation.
Just strikes me that you have 2 years of cash right now. Without doing anything, you're going to make it into 2024, which, hopefully things will be turned around. Inflation will have cooled off a bit, right? I mean, I'm hoping, because that's my FI date, but why bother, touching the dials? Just why don't you ride it out here? And then as you get closer to that time, you can start making some different, sort of calculations with respect to your cash position. But I mean, you're already there.
I've been back and forth on this in the last few weeks, and it's honestly one of the reasons that I was hoping we would talk about this pretty soon. When I look around and to kind of do my research on this topic, I don't find a ton of people, especially when you get to kind of the more conservative side of traditional retirees, bogleheads, for example, traditional and early retirees. For them, it's less about you're carrying too much cash and more about kind of these easy things you can do to maybe juice the returns a little bit. Like instead of carrying pure cash in a money market, ladder 13-week treasuries with some longer ones like 1-year treasuries because you're getting a little more yield. Yeah. And so I've been investigating all that stuff, but I keep coming out the other side like what's the goal here? You're talking about 5% of your portfolio.
Your time's worth something, right?
Your time's worth something. It's like that point that
kind of return are you going to get
coming back to Karsten, but like, are you trying to get 4 basis points here? Like, what are you wasting your time on? And I found myself doing that homework, and I don't know if it's just I was finding comfort in the idea that that feels a little better than just a pile of cash in a bank account.
Sure,
but that's really all it comes down to. It's not lower risk. It's the same risk. One is FDIC insured. One is treasuries that are backed by the full faith and credit of the U.S. Same thing, right? So what am I really trying to do there? It just seems dumb. There's I bonds and there's front loading I bonds and gifting them at a later date. Again, more hoops to jump through. But
and you got to deal with that freaking website, man.
The Treasury Direct site.
It's terrible.
But importantly, right, you're also tying up your money for at least a year.
Yeah, and we're also not addressing the big problem that I have with I bonds, and that is the opportunity cost of, the value of the asset that you're buying. Like,
that's right.
Why not? I mean, look where we are in this market. Like, valuations have corrected. Feels like a much better place to be. CAPE is down. Like, hey, why not invest in the long-term growth of these companies that, the majority of your portfolio is in already? To me, that seems like the better opportunity here. And it's a risk calculation for you, but you're going to be out almost 4 years. By the time this cash position is spent, you're 4 years into that retirement. You're going to have pretty good idea on how the sequence risk played out in those early stages, right? Those are really critical years, and you've already been spending below your planned withdrawal rate. There's just so many factors of safety upon safety. I work with a structural engineer, and he's he's always putting factors of safety on things, which I get, but the building code already has a built-in factor of safety, and so if we keep putting factors of safety on factors of safety, it's like, it's so hard to agree with the end design, which is so overbuilt. It's so overly conservative, I
think it's an apt analogy. I am somebody who is comfortable with risk, right? I was very heavy in equities the whole time. I was in accumulation, but on the same note, now I feel like I have this whole nice little structure, this little safety system and all over the place. And maybe it's a little too far and I have to pull it in, but I also find myself checking myself, Eric, by saying, if I'm instead going to take that 6-month emergency fund and put it in stock, like, am I just being opportunistic? And that's counter to what I should be doing. So this is the kind of thing I've been struggling with.
Oh yeah,
it's not keeping me up at night, but I'm also thinking, well, hey, is it not smart that I have this money retained in a tricky environment? I'm in a very fortunate position to be able to even have it as an option. It's hard for it not to feel like greed sometimes to say, well, I should put it all in, put more of it in the market.
Yeah. I mean, I'll tell you what I'm thinking about doing right now. I see where the market is. I think, okay, is it really going to drop another 20%, 30%, whatever? I guess I'm betting that it won't. But if I'm looking at my bond position, I'm like, well, I wrote it down. I got a soft landing on the bond position in my portfolio, my 70-30 portfolio. Why not just convert some of those over to the stocks and then I'll ride it right back up? And, because the ride back up, typically, as we're coming out of a bear market, a recession, it's a pretty steep ride up.
It can be.
Yeah.
Well, let's talk about that. I'm glad you brought that up. So I've been thinking about this, and I purposely waited to talk to you on camera about this. So, we had that conversation with Karsten, and you specifically asked about unwinding your bond position and going back into stocks after, spending a whole bunch of time, 3 episodes of this show talking about your reallocation. And where are you now on this idea of, well, do I take some of this now and put it into equities?
Dude, I'm a market timer.
You really are.
I'm like the worst of the worst. I'm just going to admit it. I mean, that's how I am. And I can't stand to be where I'm at with this stupid bond position. I mean, you're right. I did all the research. We're comfortable with it. My wife and I have been having this conversation. I mean, we're both on the same train on the roller coaster. Like, well, looks like there's some opportunity here.
Yeah.
And I mean, I don't know of anybody who's not looking at this market like that.
Sure.
I mean, it's even you are, right? And you're in a pretty safe position. As I look at the number in the portfolio right now, and as I look at how far I have to go, a year ago, I did the math and it's riding up, right? You do the math and say, okay, we got this number of months until the retirement date. And so contributions, okay, we're going to land there. But, when your portfolio is off by 20% or a little bit less than that, different math, right? So I'm just looking for opportunities. And I hate to say that, man, but like, am I being dumb here? Like, because I sold when it was high, converted to bonds, and then the bond position rode down.
Yeah.
It's not down as much. So I sell those and then I buy into stocks and ride it back up. Is it a dumb position?
Well, it's not a dumb position, but you're also making a huge assumption, which is that you've already seen the biggest benefit and that it's softened your landing, as you said, as the market, as VTSAX went down 20%, your bond position is down 10%. You said, well, it did its job, right? It lessened the overall risk of my portfolio. But it's only part of it. It's also a diversifying asset. Now, I get that, and I can already see the people typing, right? This isn't about return, right? This isn't about total return. I know you're thinking about return, and you did get I don't know if I'd say you got the blessing to, but you definitely got approval that if you want to unwind that position, especially, now remember the caveat, if you're willing to be flexible on your date, because if you can't do what Karsten did and just switch your allocation when you get to the finish line, because the market is in a very different place, let's say, because maybe it recovers and maybe something tragic happens again. Who knows, right? Then it was, in hindsight, not the best decision because you've gotten rid of your diversifying asset and you have to go another year. So maybe it's just make it mathematical, right? Which is more probable, but which would be more difficult for you and your family to bear, that I'm going to have to work another year, for example, versus maybe I'm not able to juice the possible return I could have gotten for that part of my portfolio.
It's, I liken this to kind of, I'm in the life raft here. I got the life raft, and then I look over there and I was like, oh, that life raft is nicer, and just knife the one I'm in and swim for that one. So I get
You don't have to knife it to go to the other raft. You can just hop out.
Oh yeah, that's an option.
Just an idea.
But you know what I mean. I'm just like, I'm not going to sell the whole position, obviously. And his advice was, for anyone who hasn't seen it, was to do it slowly. This way you're not, because the initial move that I made to reallocate was done all at once. And, I got lucky.
You got really lucky, man. You did it at the best possible time in recent history.
Almost the best.
Almost. Yeah, look at you saying almost. It's pretty close to the best. And I lucked out too, right? I went into additional, I changed my allocation at the same time, and I was able to, anyway, it doesn't matter.
I'm going to be honest though. I mean, having been through this, into this bear market, ridden the market down here, I see the value, man. And I mean, you and I both always get hammered in the comments about, oh, why are you even holding bonds?
Yep. Just answered another one this morning.
And you have to always return it with like, hey, these are not for returns on the portfolio. It's ballast. It's, there's a lot of reasons for holding bonds that are not related to return. And I mean, I'm a believer now, having been through this, even though I know, rising interest rate environment, bonds are terrible, we're losing, principal, like, okay, I get all of it, but knowing what I know now about bond funds and holding them through maturity, and the fact that a bond fund is always effectively resetting, certain bonds in the fund are always maturing, you're buying new ones. And so over time, you have something that there's real value there. Like and especially the way you and I have both gone and rebalanced toward, intermediate treasuries, and we've seen the value of that. People are running toward those in an environment like this. And they're more correlated with stocks than they have been in the past, but they are now until they aren't. And
that's right.
I mean, I can't predict what's going to happen next, but I do like having the diversifying asset. I see the value of it. I'm starting to question just a little bit like, okay, well, if I weighted more towards stocks, knowing what I know about the market right now, to me, that makes sense to do that. And I'm already having to build flexibility into my retirement date. I already see it.
You are.
It's like my wife and I are talking about that all the time now. Like, hey, I mean, it could be 1 more year, it could be 2 more years. And to us, it's more important that we have a number that feels comfortable based on the annual spend that we want, the life we want to live, the safe withdrawal rate, the fail safe withdrawal rate. That's way more important than any time point on the calendar.
No, you're right. And, I'm glad that you said what you did there, because to acknowledge the type of comments we get, maybe it will prevent 1 or 2 of them. I don't know. We do recognize that the negative correlation is not as strong as it once was. We know that the overall yields of even, intermediate treasuries is not what they once were. That doesn't mean we completely cast aside the strategy, but it does mean it perhaps gives us a little more pause, or it makes it a less obvious decision than perhaps it used to be, right? If you had that information, it was more obvious in the past than it is now. But I totally get what you're saying, because it's not black and white for you. And there are mathematically, you can easily convince yourself with those things you just said in mind, you can tilt more back towards equities if you want.
I think I'm going to make that move. I haven't done it yet. Yeah, I haven't done it yet. I calculated what I need to sell to make it happen.
Hey, and I didn't go 70-30 2 years in advance.
Yeah.
I didn't. And I, it's easy for me in hindsight to say, well, boy, that was a good thing that I did, because I got to ride this unexpected post 2020, back up,
What were you, 90-10 then?
Before I pulled the trigger, I was I got close to 85-15.
Okay.
Before, and then I increased it to 20%, and then I increased it to 30%.
So let me ask you about this transition point, since I'm looking ahead to that. To build 2 years of cash, like, did you get to your retirement number, your FI number, and then say, okay, I'm going to sell, stocks are riding up high, I'm going to sell, well, at the time, I guess it was more like 18 months of cash, right? Isn't that what you started with?
Yeah, it was 18 months.
Okay.
Yeah.
Can you walk me through what that, like, actually the timeline of that and how you did it?
Yeah. So honestly, for me, Eric, it was very simple, and it's not necessarily an approach everyone would be able to leverage, but I certainly can reference what I would have done hadn't I had the opportunity I did. So in my career, especially in the latter years, I ended up having a higher percentage of my total compensation come in the form of one-time bonus payments. And those were on a very fixed schedule. And while they were never guaranteed, because there's an element of how did the company do in addition to how did I do in my own job meeting my goals, but I knew what the floor was. So barring some tragic, market conditions, there was always going to be a floor of bonus that I would be eligible to make. And so the last bonus payment that I would receive was mere months before I was going to stop working. And so basically I ended up just retaining, most of that. I can't recall off the top of my head if it was all of it or very nearly all of it. It was quite a bit of it that ended up being just what basically topped off that amount. So yes, I did start, retaining a little more. I wasn't contributing at as high a rate in the year prior, I think it was, and then kind of topped it off with that bonus payment. But if I hadn't done that, the plan was just to kind of maybe just cut back my investment rate a little bit, my contribution rate a little bit, and then start putting it into that bucket instead. But I suppose one could just as easily and maybe mathematically better, although there's risk, just sold to fill that position towards the end.
Yeah, that's what I was wondering. Mathematically, it seems like it might be better to, instead of maintain, because my plan all along was to do that. I was like, okay, well, I'm just going to redirect some of these investment funds into a cash pile, but that seems like a big opportunity cost in itself, right?
Yeah. Well, I mean, you're balancing probabilities, right? What's the likelihood of a market decline of a certain size, and then what's the cost if you have to bear that in terms of selling more assets? Not to mention you're incurring tax on things that have gains, but maybe you'll be able to sell enough that it doesn't have gains or only has long-term gains. Yeah.
That's true. I hadn't really thought as much about that. Yeah.
Yeah.
It's funny, you go into an accumulation phase, into the decumulation phase, you do have to flip that switch. It's like, oh yeah, there's a tax.
Tax is everything now.
Consequence
managing income and managing taxes is the complexity. The path to FI can be relatively simple. It's right. How do I accumulate what I need? How do I reduce expenses and increase savings and just make smart investment choices? Buy the market. Keep it simple. But decumulation is necessarily complex. It's certainly more complex. Plenty of people would still call it simple. I wouldn't, but I do have to think about, now I'm basically living out of my taxable accounts.
I just wonder how you would advise somebody though, that like, because it seems like that situation that you had to build your cash position was just, I mean, not everyone's going to have that. I don't know how many people would have that, but so, I mean, I guess it's either selling stocks or it's you're setting a little aside, redirecting investment funds, or
maybe you split the difference, honestly, because you balance risk by, let's just say if you were somebody who was going to start with 2 years of cash, as I did, right? Or whatever that number is, maybe half of it you just kind of ramp down contribution to fund, and the other half you plan to fill the bucket with selling of positions.
Yep. Yeah. When you get there. Right.
Yeah, maybe.
All right. That's interesting.
I think it's the usual individual risk tolerance. I think this is probably less of a risk capacity question, but on the same note, this also maybe comes down to how much buffer do you have on your number, because I do worry sometimes when I hear people talking about their number and hitting their number that they're like just squeaking by, and they're calling that it, because we do get that question with some frequency in the comments. How long should you be above your number before you can say you hit it? Or And I think, I guess at the end of the day, the answer probably is best. Well, maybe one way to answer that is if your buffer has sufficient cushion on it, all of the components of it, the spending you expect, the, planning for unexpected emergencies, whatever, if there's enough cushion on that, it shouldn't matter if you just exceed your number, you call it done.
I don't know, man, if you're retiring at the top of a bull market. I mean,
that's true. Yeah. If we use kind of Karsten's,
obviously, if you can't go back and look.
You're right. Yeah. Context is important. Yeah, but context is important. You're right.
Versus, we got, a bear market, you hit your number in a bear market and you're in pretty good shape. But I did respond to a comment somebody made about, questioning my only keeping 2 months of cash. And that actually, whenever I made that comment in the video, maybe I had 2 months of cash on hand at that moment, but I don't have it now. And so, just thinking like, okay, if I had to respond to somebody that, if I don't carry an emergency fund of cash, how do I access cash given my pre-fi position? And my response is generally like, okay, my wife has a stable job. She has steady income. I have a stable job and steady income, including passive income. I have access to credit lines.
That's right.
I have a house behind me that's completely paid off. If I want to take a home equity line of credit on that, I can do that. And then lastly, I have, taxable brokerage account. And so to me, the opportunity cost of carrying cash, just holding it away seems too great.
Yeah, I get it. Well, let me put you on the spot. So you're me now, or yeah, our roles are reversed. Mm-hmm. You have my portfolio. You have 2 years of cash.
Wait, so I'm done, and you have to
you're done.
You have to work another 2 years.
Yeah, I have to keep working.
Sweet. How long are we going to keep this trade going?
You're me now. Yeah, but you have a mortgage. I'm sorry, you have to pay the mortgage. But you're me. And it's going
to liquidate your portfolio.
You're sitting here with 2 years of cash. You've just had this. You're knowing all you know. You're still going to keep that 2 years of cash?
I mean, it feels like a smart move to me.
Okay.
Yeah.
Good. All right. That makes me feel better that you're not pushing me hard. I mean, I like I say, it's more temptation than anything, right? When I see the market drop more, it's like, oh, it feels like a good thing to invest in that and be able to take advantage of everything being on sale.
Yeah, you do this a lot, man.
Yeah.
You've already won the game. Like I always have to remind you.
You're right.
You've already won the game. And like, let me ask you this. If you put your wife in your seat and ask her that question, what would she say?
She doesn't care.
Like it's not going to, I mean, is it materially going to change your life? Are you going to change how you're spending on things? Are you going to change the trips you take?
No.
I mean, because
that's why you're right. And that's why you're right. I was just, like I say, I was just curious what your answer would be.
We're both fighting the same battles, man. It's funny because, as much as we want to be bogleheads and we want to not be market timers, we just are. We fundamentally are. And I think so many people can relate to that because people are greedy, man. It's just what it is.
And you have confidence in the market, right? You've seen the power of saving and the compounding of returns over the years. And so you have confidence that this will only continue to work. And you also know, or you believe that, in good health, coming up on 50, we probably have a number of decades ahead of us. So you think, why not? Right, whether it's going to help leave a legacy behind or enable you to do the type of giving you want to do, or maybe you change the way you travel when you're much older and frankly would benefit from having more comfortable travel. You don't want to be
travel now, man.
You don't want to be, but you really don't want to be sitting crammed in coach in a middle seat when you're 70, right? Or you want to get a nicer berth on that boat if you do one of those river cruises. You know what I mean? Like it's not about present greed. I think that's accurate, right? Because what did you say? Well, that was completely correct. You're not going to make material changes now.
Yeah.
I know I wouldn't.
Yeah.
Especially in these first 5 to 10 years. Yes, I know sequence risk never goes away, but it's obviously at its worst.
You're an optimizer, man.
Huh?
You're an optimizer. You just want
to. Part of how I succeeded in the workplace.
Right. No, I totally get it. And
finding inefficiency, working it out, and figuring out how to do what you can with what you have.
Yeah, and it's actually totally fine to do that if that's what interests you. But also, I mean, I know you well enough to know that you have better things to do with your time than like wring out the sponge, like the tube of toothpaste, just kind of squeeze out that last little bit.
You know what we didn't say in the episode about checking in with a financial advisor is that he encouraged me, and maybe you had this conversation too, he encouraged me to have up to 5% of my portfolio in a cowboy account. He's like, that's where you should play around, where you want to play with options, go ahead. You want to buy single stocks, like knock yourself out. You want to try to juice gains with that 5%, go for it. Leave everything else in low fee, don't touch it. Just let it do its thing. And, it's just sitting here having this conversation, it made me think like there's actually a lot of merit to that idea. And this is probably why people like Fritz plays around with options. And we know that, Karsten does the same thing because you're still getting that like potential, like, bump from feeling good that you did something smart or you did something risky and it panned out. I don't do anything like that right now.
Well, 5% of your portfolio is your
I'm probably not going to do 5%.
2 years of your cash position. So
I'm probably not going to do 5%.
Roll that all in, man.
Yeah. Well, I mean, I still do have some single stocks, not very many. It's less than 2% of my whole portfolio. I don't do anything with them. They're all long hold, but so I guess I probably have to count them.
Yeah, we didn't really talk about that. He was too busy beating me up for not having an emergency fund, beating me up on my withdrawal rate. laughing at my number.
Maybe that's why people like that episode so much. They like seeing you get smacked around.
Yeah. I'm like paying you to do this, buddy. Is there a point at which we're keeping money in an account that's not FDIC insured, like to the limit of, I mean, are you splitting up accounts to put money in?
No, I don't have to presently, given the amounts we're talking about.
Okay. Because, I mean,
it's below the limit.
In theory, you could, right? If you were someone who wanted to keep 3-4 years cash, right? And you're,
high cost of living area or high, you fat fire,
right?
You could easily be over the FDIC limit. And some people do split their accounts then.
Yeah.
I've heard of that. I've never been in the position where I had to do that, but yeah,
Is it enough to have a joint account and that doubles it? Does that double the coverage?
I feel like it doesn't double it. I don't remember the answer to that. That's a good question. Okay. What is the FDIC limit? 250,000?
250,000. Yeah. I remember hearing something from someone who lost a bunch of money because one of their banks during the financial crisis.
Oh, wow.
Closed up shop, and they had more than two. At the time, I think, those limits have gone up over time, right? Mm-hmm. It used to be like 100. So he had more than 100 in this account, and it was just his name on the account, and he lost the proceeds. He eventually ended up getting it back, but I was like, oh, that's scary. That's
terrifying.
You see your cash position just poof. I mean, for anyone who hasn't lived through the financial crisis, that really happened. Banks really closed.
It did.
The feds showed up and the bank was no more.
That's very true.
Yeah. Anyway, did we? Yeah,
and
this?
Again, more reasons why treasuries, if you want to talk about fixed income, is a safer place to put your money than say junk bonds, where default risk is very high. You might not get that money back.
Right. Yeah.
If you're not getting your treasury money back, there's something very big going on, and you probably should get some bullets.
My kids keep it in their closets and stuffed in books, and like it's all over the place. I feel like when I go in my son's room, I'm like, it's just cash bubbling up. It's just like, oh man.
I have a little envelope of cash I keep in my kind of office area because if I get tips in cash, at the tasting room, I just have them, and I just refill my wallet with that basically. But yeah, exactly. I don't keep a lot of money under my mattress. I had relatives that did that.
Yeah,
or buried it in a coffee can. But again, it speaks to the kind of history you have, right? If you live through the Depression, your parents, kind of suffer in the Depression, right? It's going to drive some behaviors.
Sure. Yeah. I really remember watching a video, one of my favorite YouTubers in his wallet. He was doing like an EDC video, and he just showed inside of his wallet. He always carries $200. And he's like, yeah, I figured this keeps me covered wherever I'm at, I can get maybe a hotel room. I can pay somebody, for a cab ride or something like that. I thought, oh, that seems to be sensible. That's not a bad idea. And for tips, I like it.
Yeah. Well, and maybe this sounds silly, but I freely admit that, I like the idea of having that envelope with some money in it. And maybe it's only a few $100, but, there's a prolonged power outage and there's businesses still willing to transact in cash only. Like in town, you can go get some groceries, right?
Dude, that's why I have gold bars, man. I just shave off the gold bars.
Do you have gold bars? Yeah. I have a bag of Krugerrands, and I just bring and my doubloons, and I bring those down to the store.
Go buy cigarettes with it.